Having made it through to the end of what has been an extremely volatile week in which we now know the outcome of the US presidential election with President-elect Donald Trump ready to take office mid-January. Wei Li joins us now, Head of Investment Strategy at iShares EMEA. Welcome at the end of this extraordinary week. But in fact, if we look back in history, I seem to remember these sort of discussions that we had at the end of the Brexit week as well. What are the comparisons in your mind?
I think if you look at market reaction after an unexpected outcome, both in the case of Brexit as well as in the case of US election, it's remarkable how quickly negative sentiment turned positive. And in the case of market reaction to US election, the turnaround was even faster. And I think what drives it is the short memory that investors still had about post-Brexit. Market quickly turned around and some investors took a bit longer to get back into market, and as a result of that missed out on some performance. So this time around there are a lot of kind of pre-positioning for that rebound, which actually ended up feeding into the rebound itself.
So what do the markets now want to see from President-elect Trump? What has he got to say and do now to make sure that the impetus that we've seen subsequently in the markets remains?
That's a very good question, because Mr. Trump, President Trump, he had said many things on the campaign trail: immigration, foreign policy, fiscal spending, tax cuts, to name but a few, right? So in terms of what he's going to focus on, it makes sense to look at that long list and think about what is fiscally possible and what is less likely. And I would make the general comment that given that now Congress remain Republican, both Senate and the House, there is a greater chance for things to go through. Another comment I would make is that with regards to kind of the checks and balances in the US political system, policies impacting domestic economy, impacting the domestic aspects of governing will have to go under greater scrutiny, working closely with Congress, whereas policies that are a bit more outward facing, so specifically foreign policy, and also kind of walking away from trade agreement and the execution aspect of immigration. Those are the areas that actually the president has a lot of unilateral discretion. So what can quickly be done will be around kind of the trade aspect, which he has made it known that he's anti-trade, anti-globalization.
Yeah. How is this going to affect the likes of China? Because clearly the US has got to play it very carefully. China, the massive power that it is now compared to what it was at the beginning, even of Barack Obama's tenure 8 years ago, the way in which China's become such a global player now. What does Trump have to do? One, to keep China on side, and two, to enable China to work well with the US?
There is a very interesting question that doesn't have a very concrete answer at the moment, because on the one hand, if you have the US walking away from TPP, that could benefit China because China is not part of that trade agreement. On the other hand, President Trump had labeled China as currency manipulator, so you would expect greater scrutiny around China's practice of devaluing the currency, devaluing the yuan, which has so far been done this year. So you have two forces in addition to kind of the ideological differences that the countries have, that really makes this question very, very hard to answer, I think, which is also why you have a significant volatility post-US election, especially in the domestic Chinese equity market, as investors kind of focus on one thing first and then move on to the next thing second.
China holds a lot of US debt. We've seen already a steepening of the yield curve. The yields have gone up. It's going to be more expensive, isn't it, if you hold that debt to pay it back? How does this work out for not just China but other emerging markets? Yeah,
that is a very challenging aspect that is facing emerging markets right now. A dollar strengthening, yield curve steepening, all of that does not bode very well for the funding situation for emerging markets that are still reliant on cheaper funding from overseas. I would actually make the observation that emerging market countries, they're not all the same. Some countries are a bit more susceptible to this type of development and some not quite so much. So if you think about India, 3 years ago, during taper tantrum, it had a significant current account deficit. So when there were signs of kind of dollar strengthening and policy normalizing, India was very much labeled as one of the fragile five emerging market economies that would be suffering significantly on the back of this development. But now their current account deficit has closed quite significantly, which means that even if we have this kind of normalizing yield curve steepening, rates backing up environment driven by the US, they may not be as vulnerable as before, but that is not to say that they are not, which is why if you look at market reaction, broad risk sentiment has been less negative than expected, but emerging markets have borne the brunt of the negative drag.
Yeah, one of the interesting things has been in the markets has been this wild volatility. We've seen the Dow at a record high. On the morning itself, I think the Dow was down about 800 points, so massive swings in the markets. Just what does a Trump presidency mean for the markets? He's talked about fiscal stimulus. He's talked about getting rid of the Dodd-Frank Act, which was put in place to help the financial markets and the banks particularly prepare potentially for another downturn. If he takes all those away, those props away, everybody says it's going to be a lot more easy money, but at the same time, of course, you open up a vulnerability. So what markets should we be watching?
That is actually a key focus that we're trying to understand a bit better in terms of how President Trump can turn out to be potentially different from candidate Trump. So he has said a lot of things, so kind of walking away from, he is likely going to have a lighter touch with regards to regulation. He's going to have likely a heavier hand with regards to fiscal spending and generally a bit more pro-growth in terms of the policies. However, how he's going to get that done is still debatable because, for example, starting with the fiscal policy target is looking to spend more than $500 billion worth of infrastructure just on infrastructure projects, and that is very ambitious, and if it's not properly funded, then it's going to potentially blow a hole in the budget deficit. So the questions still remain with regards to how he can sustainably carry out his policy. But as I said earlier on, with regards to kind of domestic policies, there are checks and balances in place. So having a full-blown expansionary fiscal plan without proper funding consideration, it doesn't seem very likely. Which is why we actually have this potentially sweet spot where growth is starting to look a bit better, and because of the checks and balances, people worry a bit less about the unsustainability of such plan. To your question about which area we should look at, I think reviewing the list of things that is on his wish list versus if there is room to get it done, the sectors that stand out will be healthcare as well as financials because of potentially less pricing scrutiny on the pharmaceutical names and less regulatory pressure.
One final question has to be about US interest rates. Do you see interest rates in the States rising faster, quicker?
Oh, that is really hard to tell now. I think if we had a Clinton victory, then it's almost for certain that December FOMC will be the time where they hike again, given the resilience of the domestic labor market. Wage pressure is at 2.8% year-on-year, remarkable growth. But now we have this uncertainty factor that significantly diminishes the probability of a December rate hike. If you ask me if they have to make a decision today, they probably won't, but should they? They probably should, because the economy is there. So I think a lot is going to be dependent on how the next 3 weeks are going to play out. Any indication of who is going to put in place in the cabinet, and any sign of how he thinks about kind of the staffing FOMC committee as well. But as I said, it depends on how the uncertainty factor plays out versus the domestic resilience that is coming through very strongly.
14th of December, that Fed interest rate decision. Wei, thanks indeed for joining us. And of course, the 20th of January is the date at which President-elect Donald Trump takes up office in the White House, and that's another date to watch out for. That was Wei Li from iShares EMEA.